$250,000 in Broadcom dividends looks bulletproof on a spreadsheet. Until margin compression cuts your payout 25% the year you leave your job. That's not a market correction. That's a retirement timeline reset hiding in plain sight. This is the harsh reality many investors face when relying heavily on dividend stocks for their retirement income. Let's rehook. Imagine having to delay your retirement by 2-3 years due to a sudden drop in dividend payouts. This is the risk Broadcom investors may be facing. You've heard it. Nvidia just promised $1 trillion in AI revenue. Wall Street celebrated. Your dividend stocks rallied. But here's what the research shows, and what analyst reports omit entirely. Broadcom and Marvell gross margins are compressing 150 to 250 basis points as competition and input costs rise. Revenue growth alone cannot offset fixed cost deleverage. Translation: earnings growth lags revenue growth despite the $1 trillion TAM expansion. For a pre-retiree holding $250K in Broadcom at 3.5% yield, that means $8,750 annually faces a 20 to 30% dividend coverage erosion. That's $22,000 to $26,000 in lost income over the next 3 years, or 2 to 3 years of delayed retirement. To put this into perspective, a $22,000 loss in dividend income could mean having to withdraw an additional $550,000 from your retirement portfolio to maintain the same standard of living, assuming a 4% withdrawal rate. Let's pull the actual data. Broadcom's latest 10K shows gross margins declining from historical 67% to 64.5% year over year. The consensus estimate assumes flat margins going forward, but the 10K's risk factors disclose competitive pricing pressure and rising substrate costs. Translation: margin compression is already embedded in the cost structure. It just hasn't flowed through to guidance yet. Most analysts don't model this lag. They model the revenue line and the historical margin, then price in the earnings. What they miss is the delta between current guidance and the actual margin trajectory embedded in operations. Rehook. What if this margin compression is not just a minor setback, but a sign of a larger trend that could impact your retirement plans? Marvell tells a similar story. The risk factors section of their 10K explicitly states, "We face intense competition in markets we serve, resulting in pressure on average selling prices and gross margins." The company doesn't quantify it yet, but FactSet's consensus margin assumptions average 59% forward gross margins. Historical range: 61% to 63%. The gap isn't huge yet, but it signals the street is already pricing in a 200 basis point compression. If actual margins fall another 150 basis points due to input cost inflation or pricing pressure, then FactSet's base case is already 350 basis points off. To illustrate the impact of this margin compression, let's consider an example. If Marvell's gross margins decline by 200 basis points, their operating margin could contract by 300-400 basis points, resulting in a significant decline in free cash flow and dividend coverage. Here's where it gets worse. Dividend coverage flows from free cash flow, not revenue. If gross margin falls 200 basis points and operating leverage deteriorates, FCF per dollar of revenue drops faster than earnings per share. That's because fixed costs, manufacturing capacity, R&D, depreciation, don't shrink with margin compression. A company generating $10B in revenue at 65% gross margin clears $6.5B. Cut that margin to 63% and you're at $6.3B. Only a 3% revenue miss, but suddenly your fixed cost absorption is weaker. Your operating margin contracts 300 plus basis points. Your FCF contracted even more. Your dividend, priced on today's FCF yield assumptions, is now unsustainable without a balance sheet draw or capex cut. Rehook. Can you afford to take on this level of risk in your retirement portfolio? Nvidia's $1 trillion forecast validates Nvidia. It does not validate Broadcom or Marvell. Broadcom sells infrastructure, switching fabric networking chips. Marvell sells storage controllers and connectivity. Both benefit from AI capex flows, but neither has pricing power over hyperscalers. When TSMC tightens supply, Broadcom and Marvell eat the input cost. When demand stabilizes, hyperscalers negotiate fiercely on ASP. Nvidia, with proprietary GPUs and limited competition, retains margin. The dividend stocks do not. To further emphasize this point, let's consider the impact of a 30% decline in Broadcom's stock price, which could result in a loss of $75,000 in portfolio value, or approximately 1.5 years of retirement income. The risk for a pre-retiree. A 30 to 40% semiconductor correction is realistic if margin compression materializes faster than guidance accommodates. A $500K chip-heavy tech allocation could lose $150K to $200K in 6 months. That's 2 to 3 years of retirement income at a 4% withdrawal rate. If you're within 5 to 10 years of retirement and holding Broadcom or Marvell for yield, the research shows you need clarity on hidden margin pressure before Q-Next earnings reset consensus. Rehook. Are you prepared to weather a potential storm in the semiconductor sector, or will you be forced to make drastic changes to your retirement plans? The action: review your 10K risk factors yourself. Model a 150 to 200 basis point margin decline and recalculate FCF-based intrinsic value. Compare it to your cost basis and your income need. Trim or rotate before earnings cycle shifts sentiment. Consider diversifying your portfolio to reduce exposure to the semiconductor sector, or explore alternative income-generating investments that are less susceptible to margin compression. By taking proactive steps to manage this risk, you can help ensure a more secure retirement. Markets reward the patient and the prepared. Don't let margin compression catch you off guard. Take control of your retirement portfolio today and make informed decisions to mitigate potential risks. Remember, a 20-30% decline in dividend income could mean a significant reduction in your retirement standard of living. Stay vigilant and stay ahead of the curve.